Hey there, everyone. Dave Keller here, the Chief Market Strategist at StockCharts.com, and welcome to this special all mailbag episode of The Final Bar. We've been doing our live Q&A on YouTube in recent weeks, and we also have our mailbag always open to help you with your technical analysis questions on market history, specific stock or ETFs, any patterns or signals that you're just trying to understand a little bit better. We have so many questions in the mailbag. We wanted to dedicate an entire episode just to some of the questions we received recently. Let's get things kicked off here. Question number one, if interest rates keep rising, does SMH, the semiconductor ETF, automatically keep falling? So what I love about this question is you're thinking about that relationship between interest rates and semiconductors, or what I often sort of generalize a little more broadly, interest rates and growth stocks. Let's take a step back here. I'm looking at the chart of the SMH, and certainly semiconductors have started to rotate lower. You're seeing that with NVIDIA, one of the top names in 2023, showing some signs of weakness. Other semiconductor names struggling a bit as well in the SMH, of course, and the SOX now breaking through support. Arguably a pretty classic head and shoulders topping pattern, right? Or at least a lower high here in around the Labor Day holiday, and now we've broken price support. So higher highs and higher lows, an uptrend, lower lows and lower highs, a downtrend. Certainly seems more like the latter, more like a downtrend phase that may be just beginning. How does that relate to the interest rate environment? Chart I like to show for this is just $sign TNX, which is the 10-year yield on stock charts. You can see we gapped higher on Thursday. This was getting up to almost 4.5%. This is the day after the Fed meeting this week. A lot of questions about future Fed policy, but the reality is the medium, middle to long end of the curve, meaning like the 10 and 30-year points, have certainly been trending higher. The 10-year yield, which is a key benchmark to watch, has been going up. Now, usually, in general, when rates go up, that tends to be worse for growth stocks, better for value stocks. Now, why is that? It's all about what growth stocks really mean, right? With value stocks, you have in general more mature companies. They're more established businesses. They're not in an explosive growth phase, but just a steady growth phase over the long term. And a more mature company tends to pay out a dividend. It tends to kick back some of those profits back to shareholders in the form of dividend income and, more of a stable long-term play, generally speaking. Early growth companies, particularly, growth stocks that we would think of in technology and communication services, are your benefit from owning one of those stocks, or the promise is that they grow earnings exponentially, right? They're in the growth phase. They tend to be, creating new products, new product lines, new industry groups, and, things like AI. And as a result, there's great opportunity because of the promise of future earnings. But the way you calculate, for the most part, a value of a stock today is by dollarizing or by valuing today the profits they're going to have down the road. And part of that calculation is interest rates. So the higher the interest rates are, the less valuable those future earnings basically become. So higher rates tend to be worse for growth stocks. Now, what's happened is the 10-year yield has been trending higher for the last 6 months. Value stocks have actually been performing in line with growth stocks. And to be honest with you, it's been leaning more growth than value during this period, right? If you look at May, June, July, August, mid-September, this certainly has not been trending higher. It's been trending slightly lower, but at best it's sideways, meaning value stocks and growth stocks have kind of been together. That is unusual, right? If you told me the 10-year was going to be trading higher over the next 6 months, what's probably going to do better, value or growth? My answer would be most likely value, because that's what tends to do better in a rising rate environment. So if interest rates keep rising, I would not say that automatically means semiconductors go down. I would think of them as related, but certainly independent. And I like to think of it in terms of headwinds or tailwinds, right? Higher interest rates tend to be a headwind for growth stocks, a tailwind for value stocks. Doesn't mean growth stocks can't go up. It just means, awesome. Doesn't mean growth stocks can't go up. It just means it's more likely that the value space is going to do better because that's just a better environment for value. So I would not think of it as if this happens, if X happens, then Y definitely happens, but more of a headwind or tailwind. So high rates tend to be a headwind for growth stocks. I'm not surprised that they've started to roll over. I think that is related, basically the market fighting that higher rate environment, now starting to accept it. Let's get to the next question. Why do traders start to remember the wisdom of Jesse Livermore in a down market? I love this question so much, right? In a bull market, no one talks about Jesse Livermore. All of a sudden, when the market turns lower, we start bringing out quotes from Livermore and Gann and others, sort of these, famous investors from a century ago with their wisdom of how to navigate uncertain markets. There are a number of quotes that deal with this. One of my favorites, everyone's a genius in a bull market. And what I think that means is when the market is going higher, when you buy things and they tend to go up, you tend to attribute your performance to your skill as an investor, right? Everyone's a rock star stock picker when the market's going higher because pretty much no matter what you buy, it's doing okay. And so as a result, a lot of people tend to be overconfident in their stock picking and their investing ability in bull market phases because a lot of those returns are just beta, right? Are just market forces and the market's going up. So your portfolio is increasing in value. It's not necessarily because of your prowess as a master stock picker or ETF picker. In a bearish phase, we don't tend to blame our bad performance on our bad decision making. We tend to blame it on the market or blame it on, just bad luck or whatever it is. It's certainly not our fault. So when things are going well, it's all because of us. When things are not going well, it's because of someone or something else. It's very political, I guess, in how we describe our experiences as investors. I think the reality is you can get away with a lot of bad habits in a bull market phase, right? You can make less than ideal decisions. You can have an okay risk management strategy, but you don't really need it that much because things tend to work, right? When things stop working, when stocks that you've owned or ETFs you've owned, positions you've owned have been gaining value and then start to lose, all of a sudden you really do have to have good money management processes. You have to have a good awareness of risk. You have to recognize and take action when things that you own are no longer working. Again, that's very easy to ignore those things in a bull market. In a bear market, when your positions start to go down, that's when I would argue you really earn your keep as an investor, certainly as a risk manager. So I think it's because, you talk about a Jesse Livermore in this sort of environment because the reality is, even though this particular choppy, uncertain market with higher inflation and a hawkish Fed and uncertainty about interest rates, while this particular combination is unique with all the other things, it is very much a normal bull-bear cycle that has played itself out many, many times for many generations of investors. So I think it's reasonable in a down market to call on some of the market masters that have weathered previous bear market phases. I would argue, if having done this now 23 years or so, I would tell you that there's great value in the experience of having been through bear market cycles and bull market cycles, seeing things break out, selling way too early and taking a 20% profit and feeling great about it, and then watching a 200% gain after you sell it, right? While you can read about someone doing that, doing it yourself and having that experience and recognizing that missed opportunity is what prevents you or makes you less likely to do it the next time. That's why you keep holding stocks that work, right? So I think it's reasonable to think of and look back at some of those previous market cycles. Look at what the top investors did during those periods. Look at what they learned and try to learn some of those lessons as well. But I think it's more just bear markets mean bad habits become magnified. So a really good time in this sort of environment to review your processes, review your routines, and think about how you can make better decisions. Let's get to the next question. Would you use your 3 PPO setup for individual stocks? Really good question. The setup that you're talking about is what I call my market trend model. This is basically a model that I've run for a number of years, and I've run versions of this for longer than that. But I created this a number of years ago, really when I started my own research service called Sierra Alpha Research. I wanted to have a model, so I took some of the techniques that I'd used up until that point and turned it into a model similar to the version that you see in front of you. And it basically looks at weekly S&P data. I update it every Friday at the close, and it has 3 different time frames. And short-term, medium-term, long-term. And short-term, generally a couple days to a couple weeks. Medium-term, a couple of months to a year. Long-term, multiple years is the general back of the envelope time frame. Although the time frame can be fluid for sure. And it uses a combination of weekly EMAs, weekly exponential moving averages, to determine those different trends. And it's very simple. At the end, every Friday, I say, is it bullish or bearish on each of those timeframes. And that helps me just think about overall risk assessment, the overall market trend, and then everything else I do after relates back to this chart that I started every day with. So can you run it on different things? Absolutely. And I often run it on different cap tiers. So for example, on small caps, it's actually bearish on the short term and the medium term. It did that 2 weeks ago. The long term is actually very close to turning negative, and the sell-off this week seems to be magnifying that move to the downside. On other things like gold and other contracts, other commodities, I like running this occasionally just to see what the different trends are. And again, not that I would manage money or manage a portfolio based purely on this model, but I find it's a really good starting point to then dig deeper and think about, all right, these are the trends. Now, let me think a little more tactically and recognize some of the key levels and what sort of other information I can gather about this asset. So could you run this on an individual stock? Of course. And I, used a series of moving averages as long as there's enough history, meaning, something like a new IPO wouldn't be very valuable, or a really illiquid stock like a pink sheet stock or something like that, or, a frontier market name that just doesn't have a lot of liquidity. But as long as there's enough data, as long as it's been around a couple years, you certainly could run this model on there. In practice, I do it very rarely because for me, the market trend model is more of a big picture macro assessment. I want to understand the overall market conditions with some of the key ETFs that I follow. Then I dig into the individual names, and I have a different process that I would apply for those. But absolutely no reason why we couldn't do this sort of analysis on an individual stock. If you want to experiment, I would encourage you to. And if you find any great results, let me know. I'd love to see what you guys come up with using this particular model. To get to this Mindful Investor Live chart list, by the way, if you click on the Articles tab on StockCharts, go to my blog, which is called The Mindful Investor. And then right at the top, it says Live Chart List. That'll bring you to my live chart list. And the very first chart is the market trend model that we talked about. If you're a StockCharts member, you can do the following. Click Save to Chart List. You can then save this list into your own login. You can then run this particular chart on any stock or ETF that you want. And I wish you well. Love to know if you come up with anything interesting. Next question. Is it possible in StockCharts to organize chart lists, scans, etc. in folders and subfolders? Short answer is no. The longer answer, which I'm thrilled to tell you, is soon. I can't tell you when because this is in a development queue along with a lot of other things. We've got a great development team here at StockCharts that is working really hard on doing a lot of really impressive improvements. If you want to know what type of things they're working on, I would say two particular areas, probably maybe three. One whole set is like the backbone, right? So some of the functionality that drives the website, not things that you will see as a user, but you're going to find charts load more effectively, more quickly. They're more dynamic because the backbone behind the underpinnings of StockCharts are all getting major upgrades in 2023. Second big thing I would say in terms of data. So we're looking at all of our different data providers. We're trying to identify great sources of data, particularly non-US equity data, real-time commodities. We now have real-time currencies, which we added earlier this year. Real-time commodities and futures are coming next. Options we added, which we'll continue to build out. It's pretty awesome, the data team run by Julius DeKempener, which is doing some really cool things. So a lot there. The third thing in terms of functionality, if you go to the technology previews, you see some of the things that they're actively working on. This will be in our next release, most likely. Hopefully, most of these things will be included in some way. We have a new Sharp Charts workbench. So the way that you actually use the Sharp Charts, all the stuff around the chart, is going to have a nice upgrade to the user experience. Sharp Charts 3.0 is a complete redesign of our main charting engine. It has been a long time coming, and it's going to be really awesome and give us all sorts of cool things to be able to do next year and beyond. And then our redesigned market carpets will be the best heat map in the industry. I have full confidence in it. The tests that we've done are fantastic. It is visually rich and engaging and allows you to have a starting point to a really good deep analysis into a portfolio, a watch list, or a universe of stocks or ETFs. Now, what you were asking of is ChartLists, and while we're working on those major initiatives, we're also working on a lot of other things. And you maybe have noticed things like the performance capabilities, performance reports, the options reports, all sorts of other things that we've been able to add to this dropdown here in the last year or so. One of the things we're working on as well is how you actually organize these. Ours is done very simply. It's done by these numbers. And I remember when I first started on StockCharts, a couple people, Arthur Hill, Grayson Rose, Tom Bowley, Greg Schnell especially, all really good with StockCharts and really knew how to manage their chart lists well. So Greg showed me about using numbering system. Tom Bowley does these really good numbering systems to organize and reorganize his chart lists. Grayson Rose uses a number of symbols to do that. I think there are a lot of different ways you can experiment with it, but I found, just using a simple numbering system is an easy way to move them together. And then you have basically an empty chart list with these broad categories. That works pretty well for me. I would love to group them by folders and do a lot of of other things. We are doing a rework of the ChartList platform, and that should be coming. Scan engine as well, all on the list. I can't tell you when those are going to be, but I am excited as you are to get some of those things on my login. Next question, regarding bearish or bullish engulfing patterns, why does the previous day's candle need to be the opposite color? Really good question. Let's bring up an example. I'm trying to think of something, I think Halliburton, like some of the energy stocks, if I remember right. Yeah, so let's make a little candle chart of this one. All right. So here we go. This is a bearish engulfing pattern, right? We have day one, an up candle, day two, a down candle. And that is what a bearish engulfing candle would look like. A bullish engulfing pattern would be the opposite, a big down day and a big up day. And ideally, both of them are kind of larger, and day two engulfs the day one range open to close. So why does the first one need to be the opposite color? It all comes down to what the pattern is really telling you. And I tell you when you look into some of the traditional Japanese techniques like Ichimoku charting, which is the cloud and things like that, candlestick analysis, and again, traditional forms of Japanese technical analysis that many now in the West and worldwide use. Candlestick analysis is really meant to be a visual form of analysis highlighting changes in sentiment or sometimes confirmations, right? There are continuation patterns that you don't use as often. In my experience, most people use candle charts for reversal patterns. And that's what I mainly am looking for as well. And so if you think about what this 2-bar candle actually means, think of it like an upside down V, right? So day one, you're trading higher. You close up at the high of the day. The next day, you open a little higher, but you close down below the open. So day one going up, day two coming down. So it's a clear kind of sentiment reversal, bullish day one, bearish day two. The opposite would be at a bottom low. It looks like a V, right? So you have a down day, open down to close. That's a solid candle. Day two opens a little bit lower and then closes higher, right? So it's a reversal in sentiment. You're in a downtrend. You're bearish on day one. You open lower, but instead of continuing to press the downside, it actually closes higher. And so that indicates a reversal of trend. And so that's why day one and day two have opposite directions. It's all about the trend leading into that pattern, what those 2 bars tell you about the sentiment, and particularly the shift in sentiment, and then the probable course after that. And that's why they need to be different colors. By the way, if you're looking at different candle patterns, click on the magnifying glass type candle patterns. We have a bunch of articles that go through and show you really good examples of these candle patterns, what to look for. Once you're familiar with them, they almost jump off the page. That's one of the beauties of candle charting in my experience. Next question. With IWM breaking down, does that suggest a similar trend in the S&P 500? So I had a couple questions about this relating small caps and large caps. I'll point you to a couple things. First off, I would point you to my conversation with Miss Schneider this week. I interviewed her on this show, the Final Bar on Thursday's show. She actually looked particularly at small caps. And a number of my guests in the last couple weeks, and even a couple months probably, have reflected on the lack of participation in small caps. I thought Mish did a great job of pointing out the conditions here in mid-September. I point you back to Doug Ramsey, who I interviewed probably a month ago. We talked about small caps. He was actually a lot less concerned that small caps were not participating. He thought of that as more of a descriptive representation of leadership because we've just been led by mega cap growth stocks, and that's the result. So to get to your particular question, with IWM breaking down, let's bring up that chart. That's not it. IWM, here we go. So with IWM breaking down, does that mean the S&P is going to follow? So I was taught many moons ago that is exactly right? Small caps are a good measure of risk. That's why one of my charts, which I actually call like risk on versus risk off, one of the indicators is the small cap ETF versus the large cap ETF, because I was taught in bullish phases, small caps tend to outperform. In bearish phases, small caps tend to underperform. And the reason is because small cap stocks, usually less proven, higher volatility, higher beta, meaning they're more volatile than the market averages. And so in bullish phases, they help you outperform. In bearish phases, they're more of a risky play. And so you probably are going to want to unwind and get more defensive into bigger defensive positions in a downtrend. So it certainly in previous market cycles has done very well. What's different here in the last couple of years is the dominance of the mega cap FANG stocks. And because they are such a big weight in our benchmark these days, because they have been in such a strong upward phase, the small cap ETF has not been a part of the bull phase of 2023 to any extended degree. They've really been sideways while the S&P and the Nasdaq have been doing well into the peak in August. So as a result, equal weighted S&P has been underperforming the S&P. Small caps have been underperforming large caps, but instead of those being very good tells about market instability, they've basically been going down. They've been underperforming while the benchmarks keep going higher. And again, I think it's just the nature of this particular environment where mega cap growth has become such a central part of our thinking as investors. They become such big parts of the benchmark that as they do well, they continue to get a bigger and bigger weighting. As a result, the equal weighted S&P tells you other stocks are not doing well, but if the mega cap tech stocks do well, the benchmarks are still going to hold their ground just fine, even if everything else is really struggling. So I would say no. I don't think the IWM breaking down is necessarily a good market indication. I would say if it breaks down through support further than what we've seen, maybe. And that was my conversation with Ms. Schneider this week. Could the S&P and the Nasdaq go up with small caps and not really participating in the uptrend? That I could see. Could the S&P and the Nasdaq go up while the small caps are completely breaking down? That would, to me, mean we'd have to get down here in sort of the 160, 170 range on the IWM, like really break down through this base. That would be a very climactically bearish sign for risk. And I think if we do get into a full recession going to next year, most likely small caps break down below support and make a new low from the 2022 lows. And that would be a very dangerous sign, even for the large cap benchmarks that I mentioned as well. So I don't know if this particular benchmark would lead me to think, obviously, risk off elsewhere. It does tell me that the largest names probably still doing particularly well, given the fact that the small cap ETF continues to underperform the SPY. Next question. How can I scan for stocks with strong relative strength? You asked a number of things about relative strength, and again, so there are a couple things you can do when people want to find relative strengths. My first answer is, well done. That's a great call. I love your thinking, and I love where you're trying to go, and I would 100% support that. Relative strength is so important because you're looking at any name, doesn't matter what the stock or ETF is. If you want to perform well, you need to own stocks that are outperforming the S&P. If you want to underperform the benchmarks, which I hope you don't, you own stocks that are underperforming the S&P, right? And I always, I love attributing it to baseball. This comes from John Roque, who was at Texas Blyschroeder for a long time, has now gone on to great, has evolved his career to be more on the buy side, working with a number of hedge funds. And I used to love talking with John Roque regularly, and he was a big baseball fan. He was a big Yankees fan, so nobody's perfect, but he would come up to Boston and tell a room of Red Sox fans baseball analogies, but well described. And one of the things he used to say was, if you're coaching the Red Sox and the Yankees are coming into town, you want to beat the Yankees, who are you going to put on the field? Your underperforming players that are struggling, that are in a bit of a rut and aren't really getting it done on the field, or do you put your top performers at the top of their game? You obviously want to put your best players on the field. That gives you the best opportunity to win the game. Why would you do anything less with your portfolio? That analogy stuck with me so well, and I think it's 100% right. In general, you want to be unwinding things that are doing poorly. You want to be layering into things that are doing well. As Peter Lynch used to say, otherwise you are watering your weeds and cutting your flowers, right? If you want to grow a pretty garden, you nurture the flowers, you help them grow, and you trim the weeds. And unfortunately, as investors, we often do the opposite, right? We're cutting our winners, we're taking profits on winners, and then keeping to hold our losers. And that's literally the opposite of what we need to be doing. Focusing on relative strength is a very important and effective way to reverse that sort of thinking. So to your particular point, two things I would suggest. Number one, and I'll show you the two scans that I would point you to. Number one would be use the scooter rankings, the StockCharts technical ranking. I have this scan, which just looks for a couple different things, but here I'm looking for a scooter ranking above 90, and I'm looking at a particular sector, right? Stocks over a 10 billion market cap. And the group is industrial sector, and this one is grayed out. So those are really the three main arguments that I'm looking at. Scooter ranking over 90, big enough that it's a large cap stock basically, and it's in a particular sector that I was looking at. Now, why is the scooter ranking above 90 a good measure of relative strength? Well, it's a percentile ranking, right? You take large cap stocks or mid caps or small caps or whatever, you put them in a big list and you order them from the best to the worst in using our proprietary scooter model StockCharts technical ranking, which is based on relative strength. It's based on trend. And by ordering stocks based on their trend strength, you are looking at the strongest relative names if you look at the highest rating. So a scooter above 90 basically means it's in the top 10%, the top decile of stocks using our proprietary ranking system. So that is one way to look for strong names with strong relative strength. And if you bring up those charts, those are the names that have a relative strength line sloping higher for the most part. The other thing I would do is you can actually look at relative strength. And here's the argument you want to use. A couple different ways you can do it. This is the way that I like. There is a line you can put in your scans, and it's this one. So if you hit pause, just copy this right into the text of our advanced scan engine. You can do it. And it's basically this argument, which is percent relative, and then in parentheses, 20 days, and my benchmark, the S&P 500. So I'm saying, look at the relative performance versus the S&P over the last N number of days. And I'm saying 20 days, basically a trading month. And it needs to be greater than 10, meaning I only want stocks that have outperformed the S&P by at least 10% for the last 20 days. So by using this argument, changing your benchmark, changing the number of days, and changing the percent, you can focus in on stocks that have had strong relative strength over a particular look back period. I kind of like that way of doing it. And again, if you get no results, then just change some of the settings and think about, what sort of trends you're going to be capturing. But this is where I usually like to start. And it gives me a group of stocks that have done very well relative to the S&P for a particular look back period. Those are two things that I think you could do to focus in on stocks with strong relative strength using the StockCharts scanning engine. Next question. What's your take on a weekly death cross for Tesla? So I will tell you first off, I'm not a big fan of the death crosses and the what's called the golden cross, but I will bring it up here. So you were looking at Tesla. You said the 50 and 200 week, I think is what you're asking about. Let's look, because you said the weekly. Oh yeah, here we go. I see what you're saying. So you're saying, what about the death cross, right? 50 crossing down through the 200 on Tesla. So here's the thing. The golden cross and the death cross, awesome names. Love it. I often get asked about them, particularly if like a major thing like the S&P or something has a golden cross or death cross. I always get asked about it by media outlets. My answer is usually to appease them, give them something about this, but to remind them, out of all the things in the technical toolkit, this is not the main thing I would use. Here are some other things that might give you a better read on the trend in something like Tesla. So number one, what you have to remember is if you're looking at a weekly chart, 50 and 200 don't mean a ton to me. They're on the weekly charts. I actually use the 40 and 150 week because the 40 week is almost is very similar to the 200 day. The 150 week is just a longer term time frame, and I kind of like doing that. So with any of these combinations, the golden cross and death cross is just looking at when the shorter term crosses up through the longer term, and that's your classic buy signal. The golden cross, the death cross would be here when it crosses down through the 200 day, or the 40 week crosses down through the 150 week. Here's the problem. Look at where these signals tend to happen, right? You tend to get buy signals after the run has already played out quite a bit, and then things don't tend to go pretty well. Here you had a death cross pretty much at the low in 2019 before things started to improve. Here we had a death cross in February of this year, and we pulled back a bit, but overall this is kind of the beginning of a rotation higher. I found other indicators like PPO or RSI on a weekly basis are far superior to moving average crossover combinations. That's really what this is doing. It's just using a much better combination. It's using exponential averages instead of simple averages. It's using shorter term ones that actually help you navigate these turns on the weekly chart. So if you're looking for trend following turns on a weekly chart, I would be using something like the weekly PPO. Gave a pretty solid buy signal on Tesla in January of this year, and just recently gave a sell signal in August. So overall, I would point you more to things like that. Golden crosses, death crosses, if you actually back test them, not as good as you would probably expect. And I bet you will find other things in the technical toolkit probably give you a better option to follow trends on the weekly time frame. Next question, what's your take on Costco, COST, double top or breakout? Let's bring up the chart of Costco. Yeah, so you're looking at this week, of course, and this is a tough one. I always try to remind people, The macro environment has a certain, always has a certain trend, and right now I would say we're in choppy waters at best. A lot of uncertainty around the Fed meeting this week. A lot of speculation about what that means for growth stocks, and we're seasonally in a very weak part of the year. September tends to be really bad for stocks going into October, and the fourth quarter tends to be a lot better. So in general, not a time where you'd expect a lot of breakouts, not a time where you'd expect a lot of great charts to be out there. And that's pretty much what we're seeing, right? There's, the average chart right now in the S&P is more likely to be down than up, in the fact that most of the S&P, over half, are below their 200-day. Only 20% of the S&P are still above their 50-day moving average this week. So if you look at Costco, I would think of it this way, right? If I had to make a call, is this in an uptrend or a downtrend? For now, I would say an uptrend. And the reason is because we're coming off of a nice low here at 530, and we've broken back above the 50-day moving average. I would feel much better about this chart if it broke above 570, because that would take us out of this consolidation, this little sideways move. So if I had to be either long or short, I would probably be long, or looking for an opportunity to buy in. I think buying down toward 530 would probably be a really reasonable option. Is this a double top? Yeah, it's almost a triple top, right? And remember, like a number of times you've tested this resistance. The challenge I would have with this chart is now we've established a resistance level and we haven't broken out. So what I would rather do is wait, right? In this sort of environment, if you miss the move, now I'm skeptical of our ability to power through 570 because we failed to do so now 3 times. If and when we break above 570, that could be a really interesting opportunity. So one of the other ways to think about it is, don't think of it as a, all in or all out, right? Don't think of it as a binary decision. If we pull back, could you take a partial position? Would you complete it and take the other 50% if and when we break above 570? That limits your exposure in case it's the beginning of a real deterioration, but gives the opportunity to play some of the upside if it does kind of work from here. I would think of charts like Costco more in that sort of, not a all bullish or all bearish, but more a little more nuanced. And personally, based on my methodology, I'd much rather wait for something like this to break out, especially with the run that it's had, especially with the fact that it's stalled out at 570. I'm happy waiting for a breakout. And if not this, I'll look for other names that are breaking out. Maybe there's the opportunity better than Costco. Final question. I love this so much. I want to grow $2,000 ASAP so I can buy a new Corvette. Any suggestions? And I love this so much. This actually came directly from our live Q&A. By the way, don't forget to tune in every Wednesday at 1 p.m. Eastern, 10 a.m. Pacific. We go live on our YouTube channel just for an open discussion, all driven by questions that come from the chat room. It's been so much fun. We're getting a lot of random questions of all over. We've covered a ton of ground every time. It's only a 30-minute discussion, but really gives us an opportunity to hear from all of you and answer some of your questions directly. And some of the ones we don't get to, I put in the mailbag. And this is one that I had to spend time. We didn't get to it in the live Q&A, and I want to do it. So, I want to buy a new Corvette. Here are my 3 comments to you. Number 1, you're going to need more than $2,000. Unless it's a Corvette, you probably don't want. That's a pretty beat up Corvette if you're buying it for $2,000. So I would say save your money, have more than $2,000, and be patient and get a better car would be comment number 1. And a little more serious answer to your question. Number 2, an Arthur Hill quote. He often finishes his blogs with the quote, plan your trade and trade your plan. And I would tell you, if you want to get gains where you can afford discretionary purchases, and hopefully you're doing responsible things with your money, but with the play money where you can buy fun toys and cool things, stuff that you're able to lose, but you can grow if you're able to do so, you have to have a plan. I find a lot of newer investors just are trying things. They're just doing stuff. And it's sort of like throwing things against the wall and seeing what sticks. And I tell you, that is fun, and it's cool to have a Robinhood account and just pick something random and see what happens. I've done that. I actually have a Robinhood account just for goofy fun thing. I don't have much in there. It's just for like fun ideas, just to see what happens. And I don't have a problem with that. But in terms of actually growing wealth and actually, able to, growing your capabilities as a trader over time, you really need to have a plan. I would focus on what your plan is, and I would not stray from that. And think about ahead of time where your entry point is, where your exit point is, how you're managing risk, how you're managing portfolio positions, how you're managing news flow, how you're taking profits, and how you're exiting positions that are no longer working. And particularly make sure that you focus on that plan. Try to not diverge from that. And I think that's going to help you out. The third one is to cut your losses and let your winners run. I mentioned that Peter Lynch quote earlier about, you don't want to be growing your weeds and cutting your flowers, which is a lot of times what we do. Human nature is when you have a gain like 20%, you want to sell it because you want to lock in those profits, have a winning trade, feel great about it, and go high five someone at the casino and say, yep, I did it, 20 bagger, look what happened. In reality, though, if that's what you do and you consistently sell your winners, but you wait for your losers to work, you're basically downgrading your portfolio consistently. What you want to do is the opposite. You want to trim things that are not working and you want to hold on to things that are working. That's why a chart like Alphabet is just in a good uptrend and gapping lower this week. And so I think a question mark, but this is one of those charts that just keeps working. And so if it's working, if it keeps making higher highs and higher lows, why do anything but just ride that trend? The essence of trend following is to identify trends and follow those trends until the evidence tells you otherwise. So make sure that you don't cut your winners early. Ride those winners longer. Focus on cutting your losses. Have a good stop loss strategy to minimize the pain when you're wrong and to get as much as you can out of the winning trades when you're right. That is how you're going to afford a new Corvette or whatever it is you want to do. But again, I hope it's more than 2K or that's probably not a great Corvette. That's it for today, folks. Thank you so much. It was a lot of fun. I love the questions. I really appreciate them. Keep the questions coming. Our mailbag would always love to hear from you. Anything about technical analysis, market psychology, market history, particular stocks or ETFs, we'd love to take a look. Our email is thefinalbar@stockcharts.com. And of course, on our YouTube channel, even this video, just put a comment below with any questions that you have. We'll add them to the mailbag. Hope to answer your question next time we do a mailbag episode. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be well, stay safe, have a good one, and we'll see you next week.